Hello, greetings of the day. This is Professor Ramakrishna. I'm a professor of finance at Accounting and Finance in one of the business schools located in Hyderabad, India. Through this YouTube channel, that is Archiversity, I share my knowledge in accounting and finance with the students and practitioners like you across the world. So far, I created more than 500 video lectures on various topics, and it attracted huge demand or huge attention from the audiences from more than 50 countries in the world. I'm happy for that, and which actually motivates me to teach or to create more videos and share more knowledge with the audience like you. In this lecture, I'm going to show you the chart of accounts. As I from the beginning of this course, I completely insist on the accounting revolves around 5 key terms. They are the assets, liabilities, equity, revenues, and expenses. So using these 5, there are multiple sub items under these heads, and the chart of accounts are created using those different items. So in this lecture, I explain you few of them, not exactly all, I can say. A few of those items are depicted or presented to you for your understanding. As I repeatedly insist on, accounting revolves around 5 items, that is assets and liabilities, equity, revenue, and expenses. So under each of these, you have a multiple items, and to identify, to record all these transactions in account, what is that we do is we create a chart of accounts for each subhead of these. So here we have an example. So suppose you have an assets. So assets is a basic classification of your in a chart of your accounts. So first we have a separate account for a cash, then separate account for a receivables. So the cash receivables happens when you make a goods on or sale on a credit basis. So the amount that you have to receive from your customers is receivables and other allowances for your doubtful debts. Then interest receivable. Suppose you make an investment into or short-term investments or long-term investments, and those investments fetch you interest, that is investments. Then you have an inventory of your stocks, inventory of your supplies, prepaid insurance, that is insurance paid in advance, then your prepaid rent, your property, that is a land, equipment, your depreciation account, buildings, so copyrights, goodwill, patents. These all are different accounts under the head assets. Similarly, when it comes to the liabilities, in case of liabilities, you have a notes payable. Notes are very short-term borrowings which you borrowed from the banks or from outsiders. Then you have accounts payables. The amount is due from your creditors. Then unearned service revenue, that is you took advances but service has not been delivered. Then your salaries and wages, the amount to be payable. Then unearned rent revenue, that is rent you are supposed to receive but not yet received. Interest amount payable, dividends payable, income tax payable, bonds payable, discount on bonds payable, premium on bonds payable, mortgage payables. So these are the different accounts under the head liabilities. Then you have a account for owner's equity or shareholders owner's equity or owner's equity in simple terms. So your owner's capital, the initial amount invested by the owners, then drawings, any amount withdrawn by the owners from the business, because we are saying that one of our accounting principles is that business is a separate entity from its owners. So any amount withdrawn by the owners is a liability. Then the common stock that they have, paid in capital, preferred stock if any, then treasury stock, retained earnings, dividends, income summary. These are all the different accounts under the owners and shareholders equity. Now when it comes to the revenue, you have a revenue from service, revenue from sales, and you get a sales discount, sales revenue, sales returns and allowances, interest revenue, gain on disposal of a plant and assets. So we create separate accounts for these different heads under the revenues. And when it comes to the expenses, you have different types of expenses that you incur advertisement expenditure, amortization expenditure, bad debt expenses, cost of goods sold, depreciation expense, freight out, income tax expenses, insurance expense, interest expense, right? I mean, similarly, rent expense, salaries and wages expense, supplies expense, utilities expense. So these expenses, when you say that this is a cost incurred, or simply we can say that a paid. So any amount that is expense that you paid are shown under the head of expenses. Our main head is expenses, under which these are the sub heads. But if you have to pay these expenses, then they become a liability. So here you can see that mortgage payable, discount, bonds payable, or we can say that interest payable, right? Dividends payable, salaries and wages payable. So if you are payable, that means you owe. So those will become a liabilities. When you incur a cost and you paid, that is your expense. So as now accounting is transforming from a book and pen and paper to the information technology base, as we have a many information technology applications for accounting, like a QuickBooks, like Wings, then you have a Tally, or you have at a higher end you have a Oracle ERP, then you have a SAP. In such a case, the chart of accounts are created with a code names. Suppose for all our assets, we code them as from any number from 100 to 199. So in each account, that is your checking account, in the sense your bank current account. So for a current account, we give a code of 110. So for a cash account, 115. For savings account, 125. Like this we give. So suppose you have a plant account. So for plant, you may give 175. So you have a buildings. So for buildings, you can give an account number 180. So these all will be, we are coding them, in the sense when you are giving a number. So we are creating chart of account and creating a codes, so that while running your applications or entering your data, it would be easy for you just by looking at the chart of accounts and their codes. Similarly, for liabilities, we give a block from 200 to 299. In that, sales tax collected 205, accounts payable 225, payroll tax liability 240, credit liability 240. It is not that exactly you go this way, but based on the size of your organization, based on number of accounts that you have, you may have a bigger series also. Say somewhere you can start with your series with 1,000 to 9,999. If you have a large volume of operations spread across the countries, in such scenario, you can code them anyway. All right. Then you have equity accounts. So equity accounts are coded like this: owner's equity. Then we have income accounts, or we can say that revenue. For revenue, we have a code like a bank account is given one code, and product ABC sales, product XYZ sales, miscellaneous income. So different codes are created. Then here you have a expense account, advertising expenses, then your equipment, insurance. So these codes, that means your basic chart of account. From this, each major heads like assets, your liabilities, your equity, revenue, and expense will have a major codes. Let us say assets will start with a 1. So, and series 1, and series 1 to 9999. And your liabilities may start with another series, or let us say 1 to 999. Then you can have a series 2, series 3, series 4, series 5. Under each series you can go, or you can give other codes also. So the basic idea of a chart of accounts is to see that, to understand what are the different accounts that as an accountant you are preparing, and how those accounts are interrelated with each, and how they are coded. So this is a basic idea of creating chart of accounts for your business. Thank you for watching the lecture.